right there. Okay. So good morning, folks. We're here. So it's 9:39 a.m. Ghana time. Welcome to our market review for today, 12th of July, 2023. And remember, this is not supposed to make you trade with live funds, okay? This is not meant to also be a financial advice, but specifically for just educational purposes, okay? So you determine when you can trade with live funds. But I would advise that you go through the study with us. You get to know what the market is doing, and we get to know how price is delivered before you go into trading. All right. So let's get into the market. So one of the first things we basically do is to check the forex calendar market, okay? And I gave you guys the site forexfactory.com. Is to check, first of all, to know the sentiment of the market, okay? To know what the market's likely to do today. And we mainly focus on the red boxes, which represent high impact news, and then the medium boxes, and then the brown boxes, which represents the medium impact news. So those ones obviously helps us to know the type of volatility that is going to be pumped into the market. We as smart money traders, when you have this information, you are informed of when price is going to inject volatility in the market. So that you try to avoid those time frame. So at 8:30, you try to avoid trading before 8:30 or during 8:30, but you try and trade after 8:30 because the volatility is actually not going to any direction. It's actually manipulating the markets. The big institutions are trying to rearrange their orders. They're agitated. They're trying to do something in the market just to avoid losses or something. So you have back and forth price movements. But after those movements, we, the smart money traders, get to see where the orders are resting, okay? And the price, the market is programmed in such a way that there are buy stops and there are sell stops that the big institutions and the various banks go for. Okay, they go for those ones in the form of liquidity. Okay, they go for it. All right, they go there to exchange prices for another, and so that they can go to the opposite direction of the market again. So once there is manipulation of the market, there is orders back and forth. What generally happens is that it's likely that they are going to they are going to capitalize on those highs and lows and go there for orders and trade the opposite direction. So the forex calendar helps us to know what liquidity will be injected into the market, and then after knowing the sentiment, now you go into the technical side of the markets, which is the real chart, which will then inform you of what you need to do next. technically. So let's go into the chart and see what we can do technically on the chart. So one of the main things that you do is to start from the weekly chart, because of course you are trading within a particular week. So number one, you need to ask yourself, what are the types of candle formation that has happened from last week? Now, I was mentored by this guy called Michael Huddleston, and he taught me on how to recognize some candle formations and on how prices are booked on those candle formations. Okay. So he never taught me anything concerning these retail logics, harmonics, you know, harmonic patterns and all these other ones, Wyckoff and all these ones that you know of. None of that. I mean, we've all followed that. We realized it never worked, but we can see that this ones actually that he taught is actually what price actually tends to respect. And there are sensitive areas that price actually uses as support and resistance. Okay, so it's important that we understand the logic that we are looking at. So first of all, we need to ask ourselves, what is the candle formation looking like? Okay, so if you look at last week's trading, there's a candle formation that this price went into, okay, which is the order block. Now this is another block. What is another block? Another block is when there's a down close candlestick that's formed on the 20th of July, on June. Okay. The following week, trades above it, closes above it. Okay. Now once it closes above it, the high, the open, and then the midpoint of it are very, very sensitive price points. Okay. Yeah, they're very, very, very high sensitive price points. So you notice that the following week, that was last week, price opened up there and traded back in. Okay, so actually I was bearish from last week because I noticed that either we are going to that midpoint or the opening of this price or the high of this price. Okay, so now notice how this week, the same way price open went back to that point, that midpoint, okay, and then rallied up. So you want to ask yourself, where has price been to? Price has gone to this midpoint here, okay, and it's going back up. Going back up into what? There's a swing high here, okay. A swing high occurs when there's a candlestick that forms lower. This candle forms higher than this, then the next one forms lower than the middle one. So then it creates a swing high. Okay. So number one, candlestick formation is the order block. Okay, and inside the order block, we have the midpoint of the order block, the high of the order block, and then the open of the particular order block, which are price sensitive, which are candlestick formation. We need to note it down. Okay. Then we ask ourselves, so this current new week, where has price gone to? If price has gone to touch any of these candlestick formations, where is it now going to? Is it going for a swing high? Is it going for another order block on the opposite direction? Is it going for a midpoint of an order block in the opposite direction? Like this, as it's going up, what is it going to look for? Okay, is it going to look for a swing high, or is it going to look for another order block, or is it going to look for a fair value gap? Now I drew this rectangle here to delineate this gap here. It's also another candlestick formation that price also gravitates towards, okay, which we need to also pay attention to. Okay. Yeah. So let's move to the daily chart. So look at the daily chart. Notice how price came to perform magic at the midpoint of the weekly. You remember this line here, the midpoint of that weekly order block. Remember how the magic happened? Price came back down, took it. This was, I think, last Thursday. And then the Monday also, price came back down there again. And then it's going higher. So this is it's actual support and resistance levels. Just reading candlestick. These are just candlestick readings, okay? So market doesn't follow these kinds of retail mindsets that you read in your books. This is what actually support and resistance levels are. So once price comes down, you should ask yourself, where is price likely to go to next? Okay. And these are the highs. And then the gap that we saw on the weekly, which is above this high here, is where market is likely to draw to. So once the news event occurs, once it occurs, you can either take out the high, okay, first, or it will come down. Most of the time, we want to see price come down to take lows on the lower time frame. So I think let's go to the lower time frame. 5-minute chart. Okay. And this was the high this was a low on the weekly chart. So this was Monday's trading. You can see that market opened, came back down, took out that, traded into that midpoint on the weekly candlesticks, took out a low here. Okay. And like I said, market always goes to highs and lows and they seek after liquidity. That's how big institutions book their prices. So once the liquidity was taken below this low, you can see that they went all the way back up, traded all the way back up to the next liquidity, which rested about here. You can see it right there. Yeah. They took it out on this day. It was taken out. Okay. So somebody will say, so then it means the next liquidity is down here. No. In this context, once they take out this high, they are still going up on the weekly. So the weekly would like to achieve its objectives before we think of it coming back down again. All right. So that's it. So remember the patterns that I showed you, and once markets went all the way up, that's why sometimes Mondays, so this is a Monday, that's why sometimes Monday we want to watch what price will do. So that Tuesday you can see that at 9:30, this was 9:30. Okay, market went all the way back up, took out the highs here, came back down. Now note this down. Anytime we are anticipating price to go up on the weekly, and we go down to the lower time frame, like a 5-minute time frame, we look out for a low to be taken, number one. Then we look out for breaking market structure, number two. And then we look out for a fair value gap to enter our trade in the direction of where we are anticipating the weekly time frame to go to, the weekly order candlestick to go to. So for example, we are anticipating that the weekly candlestick will move higher. So we are anticipating higher prices. So once the 9:30 bell opens, we are not interested in the highs being taken. We're really interested in the lows being taken. So the lows is described using the fractal another factor. So you see the big candlestick coming down, taking out all these lows, swing lows actually. Market goes up. The structure of the market is not being broken, which is the swing is not being broken. So it still took it. It didn't go up there to break. It came down, broke below the low. Market structure is still bearish. And then once it also takes another low here. Okay. The one is once it takes out this low, look at what happened. It breaks above here. Okay. Zoom in a bit. Okay. It breaks above here. Okay. Closes here. Now, once it breaks above here, we look out for a gap. Okay. For entry above. So this is a gap. Okay. This candlestick high, and then this candlestick low. There's a gap here. So we can see how markets came back down, took out orders in that gap before it rallied up. Now, as it is rallying up, what is it seeking? Liquidity above the market price. So you can see it, as it entered, it seek this liquidity and seek this liquidity. You can see. So I think this entry was 44.52. The high of this one is about 44.57. That's 50 pips take profits. This one is 58. That's 60 pips. You could have taken partials here and taken the rest of the trades here. Rest of the profits here. So once your entry is here, stop loss will be below this low. That's about 47. That's about 40 pips. Yeah. Which is normal. Okay. So these are the type of trades you need to be able to meet your need. So like I said, if you are able to make $250 every week, 4 weeks, you have your $1,000 with you. You've been able to meet the need of food. So as time goes, you can increase it on and on and on and on. So once you are done for the week, you are done. Like, seriously, you are done. Okay. So you can see how. So I just showed you how you can trade a day before even high impact news. But most advisedly, I would like to encourage that you trade after the news event. This is the most advice I'll give. So we are about what's the time? It's 10. So we're looking at 11, 12, 2 hours, 30 minutes more left for the news event to occur. And once it occurs, we'll see if we can have some live sessions of trading, or maybe after that, I'll show you my entries on another post. I hope you enjoyed this, and I hope this has informed you a lot on how prices book on the markets. So until we meet in the afternoon, be safe.